What is going on, traders? Welcome to the Chop Zone. Also, welcome back to the Traveling Trader, your source for non-BS, concise, regular market updates. So we are officially in the Chop Zone. The Dow is down 300 points. The S&P was down almost 0.6% today. NASDAQ down almost 0.5%. So I'm going to tell you why there are three things you need to look out for in the short term. And if you haven't seen the disturbing September trend for the stock market, watch my video from yesterday. However, even including all of this, I will tell you why it is not all that bad and why there is light at the end of the tunnel. So you definitely want to stick around for that. Also, I will be telling you what plays I'm looking at, what current plays we are in as well. You guys love when I give updates to this stuff. Follow me on Twitter. I do give a lot of updates on Twitter as well. I also send out a lot of alerts on Twitter as well as my analysis. So follow me there as well. And without further ado, let's get right into it. So as I said, the indices are down today. There is this trend now in September where the indices usually start green. It looks like it's going to open up green and then the market fades and we turn red. We are definitely in choppy territory right now after making another all-time high just a week ago. But here are the three things you must know. Okay, so thing number one. Here's the S&P 500 chart. Look at the 50-day moving average, which is the orange line on my chart. This is usually a point that is in all of 2021, really going all the way back to end of last year, to end of 2020 after we hit that near correction. The 50-day moving average has been the major test for the S&P 500. We've hit it 6 or 7 times since then and have bounced off successfully. So we are there now. This is why I call this the moment of truth for the S&P 500. So that is the first thing you want to watch out for here is whether the SPY will maintain the support level at around 441 or not. If we close below that, then you can expect us to start hitting pullback territory, which means a drop of at least 5%, which miraculously has not happened in 2021. But that would put us at the 100-day moving average at around 430, 431. Again, go back and watch my video from yesterday, but this would also corroborate the timing of the famed September 17th, this notorious September 17th date, when we usually see a drawdown in the S&P 500. This data has been compiled over the last 23 years. It doesn't mean it will always do this, but this is what it does on average. All right, the second thing that you need to watch out for is the options data. If we take a look at the SPY options data, right? This is the ETF that tracks the S&P 500. I'm using Market Chameleon here. By the way, if you want discounts on all the tools that I use, you'll find all the links in the description. But either way, the option order flow for the SPY is right now, it's signaling bearish. There are more bearish positions open than bullish positions, and a lot of this is institutional money just based on the notional value of these positions. If you look at the open interest, you'll see that there are double the puts open than calls, right? So there are more bearish positions, more puts open than there are calls open right now on the SPY. So what this tells me is that large players in the market are expecting the SPY to drop, or at least are hedging their positions. Now, we hedge a lot in our private trading group as well. We had a bearish NASDAQ hedge that we closed for 90% last week. We even hedge against our individual positions. We had a Netflix bearish spread that we closed for 50% profit this morning, as well as a bullish play on the volatility index, otherwise known as the VIX. If you want access to all of our trades, including all of these hedges, know how to play the downturns in the market or the potential downturns in the market, link is in the description below. Come be a part of the group. Would love to have you. But what I was saying was a lot of experienced market traders, a lot of institutions, they open up hedges in the form of options against their long position. So we have an ultra long position on the SPY, right? We've been long on the SPY for many years. However, in the short term, when you are feeling uneasy about your position, when the market looks toppy, when the market looks volatile, you can hedge using options while keeping your long positions intact, but use options in order to try to protect against your position. So for instance, if you have a lot of S&P based stocks, one thing you could do is you could just buy protective puts on the SPY, Google protective puts. You can also sell call vertical spreads, which is a bearish position. You can buy vertical put spreads. These are all things that I explain in the trading group as well as in the course, but you can find this information for free online if you Google these terms as well. So that is the second thing to watch out for. The third thing that you need to watch out for in this current market climate are the economic indicators. So the consumer price index came out today. The inflation was actually better than expected. The inflation numbers that came out today were actually better than what the analysts had predicted. We also have a record number of jobs open, right? Almost 11 million jobs open in the US. This is a record in history. So part of the reason that last week when those disappointing jobs numbers came out, right, we only added 235,000 jobs compared to an expected 733,000. Part of the reason is because there are so many goddamn jobs open already. And companies are having a tough time filling this because there is so much helicopter money out there. So although the inflation numbers are better than expected, what I'm really worried about in the long term is stagflation, because there are so many jobs open that companies will now have to raise wages. That's basically when inflation and wages go up, right? And unemployment remains high because in this case, there are a lot of jobs open, but companies are finding it hard to lure workers back to work. But here's why it's not all doom and gloom. Yes, in the very short term after September 17th, which is a major options expiration date as well, we tend to see the market drop. A lot of good earnings are priced in. There aren't many catalysts between now and the end of the year. The S&P 500 has not yet seen a 5% pullback. So if it is going to happen, it might happen now. But just take a look at this chart once again. Yes, we could have a downturn, but usually the S&P 500 ends up higher than it was even at this point, ends up higher than it was in the beginning of the year. If you take a look at this chart, which I shared on one of my previous videos as well, when the S&P 500 is roaring through August, we usually see a positive end to the month as well. And currently we're up over 20% through August. One last thing that I will say about this is that even if we drop 5%, keep things in perspective. Just like Einstein stated in his theory of relativity, time is relative to your frame of reference. So if you're coming in the market just now, yes, you're going to feel the house of pain. However, a 5% drop from here would put us at the all-time high that we saw just a month ago, right? When the S&P 500 made an all-time high like ever. A drop of 10% would put us at the all-time high that we saw just 2 months ago, right? So it is all about perspective. Even if we drop 10%, which would be an official correction on the S&P 500, the S&P would still be up 12% on the year, which is nuts. Corrections are healthy. Corrections are necessary. It is essentially a reset button to allow investors to cool off from their exuberant emotions, reanalyze company valuations. It also gives companies the chance to release some steam, release some of the pressure of continuing to meet higher earnings. So just keep that in perspective. Okay, in terms of what I'm looking at to invest, right now I believe on the indices, this is a dollar cost averaging point, but you can dollar cost average slowly here in my opinion, especially because of the fact that we're in September and all of the factors that I discussed in this video and the last video. I think that we could see a correction here. Obviously, I'm not Nostradamus, right? But we could see a drop to the 100-day moving average, in which case I would load up heavier. So this is mostly a wait and see moment for me on the indices. I'm very curious to see if Apple can hold the 50-day moving average here. I'm not opening up a new position on Apple. I want to see what happens after today and next week. I stated this in earlier videos, but I'm looking at some finance stocks like Visa, which is sitting at the 200-day moving average. I think it's a great value stock here. I'm looking at Citigroup as well, sitting also at the 200-day moving average. I'm looking at Boeing at the 300-day moving average. This is more of a reopening play, so it might be a very long time before Boeing gets back to the days of lore. Looking at SoFi here at support. I actually like selling cash secured puts on SoFi. I like Robinhood here at the $40 mark. I don't think the SEC is going to ban payment for order flow, because that is not just a Robinhood problem, but that would also affect some of the larger brokers like Charles Schwab and TD Ameritrade, and they have too much power, frankly, in my opinion. I'm looking at Zoom to see where it finds support. It is currently at a major support level here. I don't mind starting a position on Zoom, dollar cost averaging at this point, but we could fall further down to maybe the 250 range, at which point I would buy in heavier. Going into the holidays, I'm definitely looking at some of the video game stocks like Activision Blizzard. EA to me is a little bit high here, so I don't already have a position in this, and I'm not about to establish a new one. However, Nintendo looks like it's beat up as well, so NTDOY. Looking to see if it can find support here. I already started a position on Nintendo back when it was under $60. Looking at AMD sitting here at the 50-day moving average. Guys, there are so many stocks here to look at that are sitting at support, right? We don't always have to buy things at the all-time high or FOMO into things. Same thing with NEO. NEO is sitting below $40 at the moment because they issued a lot of stock. They're sitting at the 300-day moving average. I believe this is a good dollar cost average position for the long term. But there are so many stocks here to look at. And the good thing is that we have the luxury of time, being that the market looks like it wants to slow down, at least in the very short term. Again, I'm not Nostradamus. This is just my analysis. Time in the market beats timing the market, especially if you are investing and not trading. And if you know how to trade options, it opens up a whole new world and gives you that many more tools in your toolbox to be able to play the directional short-term moves. Again, if you want access to all of our trades, link is in the description below. If you want to learn how to trade options, I also put together a course, over 100 hours that I put together in that course. Link is also in the description. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.